The United States of America's economy, one of the world's largest economies, is run as a free market economy in terms of consumer goods and commercial services. Even in these domains, the government maintains a strict regulatory framework to ensure the general welfare. It functions as a command economy in the military, with certain retirement benefits, medical care, and a few other areas. Here, we will discuss what exactly is the U.S. economy. Fast facts about the U.S. economy. We'll find some of the most critical information on the U.S. economy here. The health of the U.S. economy as of late can be deduced from some economic indicators. The world's total gross domestic product, GDP, was $25.66 trillion in 2017. Nominal third quarter of 2022. The growth rate of the GDP is 2.6%. Annualized rate, third quarter of 2022 first estimate. Real GDP per capita, $60,082. Third quarter of 2022. Gross national income, $23.4 trillion, 2021. Unemployment rate, 3.7%, November 2022. $7.25 an hour is the federal minimum wage. The U.S. dollar is in circulation. Conversion from euros to dollars, $1 on average, September 2, 2022. How to measure the U.S. economy and what it means. Gross domestic product, GDP, is a way to determine how much everything made in the U.S. is worth. It is used in three other ways to help economists figure out how much a country makes. Nominal gross domestic product, GDP. This annualized measure shows a country's production level using current prices but does not account for inflation. Real GDP. This achieves the same thing as the previous method but eliminates the effects of inflation. Economists use it to examine changes in GDP over time. GDP growth rate. This ratio uses real GDP to compute the growth rate relative to the preceding quarter or year. It can be expressed as a percentage. There are four components of GDP. Number 1. Spending by individual consumers accounts for around 68.5% of the overall amount. Number 2. Manufacturing, building new real estate, and developing intellectual properties all fall within the purview of this aspect of business investment. Number 3. Expenditures made by governments at all levels include those made at the federal, state, and local levels. Number 4. The value of a country's total exports minus the value of its total imports is known as its net exports. Net exports include both exports and imports. Major factors that affect the U.S. economy. The sum of all the money that the federal government earns and spends is known as the budget. The majority of the money that the government takes in comes from income taxes. Most of its expenditures are directed towards three significant costs: the costs associated with Social Security benefits, military spending, and Medicare. If total spending is greater than total receipts, then there is a deficit in the budget. Since 1970, the United States federal government has operated at a deficit in all years except for those 4 years, 1998 to 2001. The amount of debt continues to grow with each passing year's deficit. The United States often has a trade imbalance as well. This indicates that the nation's exports are lower than its imports. Debt to GDP ratio. At the end of October, the total amount of the national debt held by the United States was close to $31.3 trillion. 13, that is greater than the nation's economic production. The debt to gross domestic product ratio best illustrates this phenomenon. By the end of the third quarter of 2022, it was approximately 122%. National debt divided by GDP. When a nation's debt to GDP ratio reaches more than 77%, some economists believe that the country will enter a phase in which each increase of 1 percentage point of debt results in a fall in annual average real growth minus 0.17 percentage points. Yet, if a nation can maintain a debt to GDP ratio lower than 77%, an increase in debt of just 1 percentage point will increase yearly average real growth. Durable goods orders. The quantity of orders for durable products is reported, which are expected to last for more than 3 years. 16, because of the tremendous cost involved, most of this comprises commercial and military aircraft. Furthermore included are vehicles. Capital goods are an important metric when discussing the durable goods category. That is the machinery and equipment that is necessary for enterprises daily. They will only order these products once they are confident that the economy is improving. The Federal Reserve. The United States' primary banking institution is the Federal Reserve System. It can change its monetary policy stance using a wide range of tools. Interest rates, the federal funds rate, and open market activities are the main topics of discussion. Federal Reserve. Interest on reserve balances and overnight reverse repurchase agreements serve as the upper and lower bounds, respectively, of the target range that the Fed establishes for the federal funds rate. Regarding Federal Reserve, the Federal Reserve establishes a target range for the federal funds rate. Rates of interest. Financial institutions levy interest fees against one another for overnight borrowing. The Federal Reserve goal range is somewhere in the middle of these rates. The interest rates affect the short-term interest rates the banks charge other businesses and individual customers. Open market operations. To affect long-term interest rates, the Federal Reserve can buy and sell securities on the open market. Because of these powers, the Federal Reserve can modify interest rates and the amount of money in circulation without being able to dictate how banks should conduct their business. To implement an expansionary monetary policy, the Federal Reserve has been lowering the target range for the federal funds rate. The cost of borrowing money is lowered, speeding up economic growth and decreasing unemployment rates. If the economic growth rate is excessively rapid and contributes to rising prices, the Federal Reserve will implement a monetary tightening policy. It will do this by raising the Federal Reserve target range to slow lending and expenditure, which will slow demand. The administered rates in the Federal Reserve, also known as the Federal Funds Rate Target Range, impact the spending decisions made by consumers and companies, which helps the Fed maintain healthy levels of economic growth, inflation, and employment. The Federal Reserve performs three more functions. First, it is a watchdog and regulator for many of the nation's banks. Second, it helps maintain the financial market's stability and makes significant efforts to prevent catastrophes. Thirdly, it offers banking services to other financial institutions, the United States government, and international institutions. Commodities Market. The volatility of the commodity market has been a significant factor in the economic performance of the United States. The exchange of goods such as oil, food, and metals occurs in this market. Prices of commodities are susceptible to being strongly influenced by market variables such as supply and demand. As a direct consequence of this, the prices of all of these products could see a significant amount of swing from time to time. Alterations in foreign currency prices, which affect imports and exports, can further compound this problem. What are the main things that drive the economy of the United States, and how have they changed over time? Different sectors, such as manufacturing, services, and finance, drive the economy of the United States. In the past, manufacturing was the most important sector. In the middle of the 20th century, it made up more than 25% of the GDP. In recent years, however, the service sector has become the largest contributor to GDP, making up more than 80% of the economy. This shift towards services is mostly caused by technological changes and how people act. For example, the rise of e-commerce has made it possible for more people to buy goods and services online, which has helped the digital economy grow. The finance industry has also been very important to the U.S. economy, especially since the financial crisis of 2008. Banks, investment firms, insurance companies, and other financial intermediaries are part of the financial sector. The crisis showed flaws in the financial system and led to several changes meant to improve regulation and oversight. Since then, the financial sector has returned, with banks and other financial institutions making record profits in recent years. International trade is another important thing that drives the U.S. economy. The U.S. is one of the largest exporters and importers in the world, and international trade makes up a big part of GDP. But trade tensions with other countries, like China, have made businesses and consumers uncertain, which has caused trade volumes and economic growth to fluctuate. How has the COVID-19 pandemic affected the economy of the United States, and what has been done to reduce its effects? The COVID-19 pandemic has had a big effect on the U.S. economy. Many jobs have been lost, businesses have closed, and GDP has dropped sharply. The pandemic caused the economy to slow down quickly and severely, and many businesses had to close either temporarily or permanently. In April 2020, the unemployment rate was almost 15%, the highest since the Great Depression. As a result, the U.S. government passed several bills to help the economy. The CARES Act gave money to people, businesses, and state and local governments. The CARES Act included giving people direct payments, increasing unemployment benefits, and giving small businesses loans and grants. The Federal Reserve also did many things to help the economy, such as lowering interest rates and giving financial markets more cash. Even though these steps helped reduce the effects of the pandemic on the U.S. economy, the recovery has been uneven, with some sectors like technology and e-commerce doing well while others, like tourism and hospitality, continue to struggle. The pandemic has also shown up inequalities in the U.S. economy that was already there, like how low-income workers and minorities are more likely to lose their jobs and have their incomes drop. What is the role of innovation in the economy of the United States, and how has it helped it succeed? The United States of America is home to some of the world's most innovative companies and industries, which has enabled the country's economy to thrive and become one of the most successful in the world. The dedication of the United States to research and development, combined with the country's highly skilled labor population, has allowed it to become the world leader in creating innovative technology and goods which have, in turn, revolutionized entire sectors of the economy. The internet, created in the United States and has since fundamentally altered how people connect socially, commercially, and with one another, is one of the most outstanding examples of American ingenuity. The smartphone, biotechnology, and other forms of renewable energy are all examples of breakthroughs that can trace their roots back to the United States. The United States of America operates with a command economy and a market economy, creating a mixed economy. Compared to other nations worldwide, the United States is one of the more market-oriented nations. Nonetheless, it imposes stringent rules and limitations in particular spheres of activity. Although economists don't always reach the same conclusions, the gross domestic product, GDP, is the metric most employed. If you want to compare national economies, you could use real GDP. But if you want to track a nation's progress over time, you could use GDP growth instead. The Federal Reserve's charts include real GDP and real GDP growth data updated quarterly. So that's all for today's video. If you like this video, click the like and the bell buttons. We'll have another video for you soon. Take care until then.